America's Commercial Real Estate Show is brought to you by Bull Realty. When your business requires proven performance, visit bullrealty.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit agg.com. And Cone Resnick, providing forward-thinking advice to help navigate business and financial issues. Visit coneresnick.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome to America's Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with. And laugh, I think we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. If you have any questions or comments related to this show or any commercial real estate endeavors, you're invited to contact us through email or Twitter. Our email is info@creshow.com, and our Twitter account is @BullRealty. Today, we're going to look at commercial real estate market predictions for 2013. The market is very interesting right now. It can be very different depending on your sector and your location. We see compressed cap rates and intense demand for some properties, while you might drive by some see-through buildings and vacant strip centers in many areas as well. So where's the market headed? Where are the bright spots, and what should we look out for? While location is still important, the new real estate mantra is timing, timing, timing. So let's see what lies ahead for us in 2013. Please welcome my first guest, Bob O'Brien, Partner and Vice Chairman, U.S. Real Estate Services Leader, Deloitte & Touche. Bob, thanks for joining us.
Great. Thank you, Michael, for having me.
Well, we appreciate you sharing these top 10 issues that we should watch out for. And the first one's macroeconomic fundamentals. What do you see there?
Well, macroeconomic fundamentals have been relatively weak since the end of the recession in June 2009. 5 out of the last 6 quarters have had GDP growth below the 15-year average. As we look forward to 2013, we see growth at or below the 15-year average of slightly in excess of 2%. In addition, although the unemployment rate is improving, the labor participation rate has dropped by almost 3% over the last 3 or 4 years. And so as a result, in effect, a lower percentage of our population is working. So what we see is, although we've seen a great recovery in real estate fundamentals over the past couple of years, we think without more robust economic growth, it's going to be difficult for real significant growth in real estate.
Wow. Well, let's talk about some of those fundamentals. What do you see there?
Well, in terms of the commercial real estate fundamentals, what we're seeing is vacancy rates have improved over the last couple of years. We've begun to see growth in rents in apartments, in office, in lodging, in industrial, and we're forecasting that in retail we'll see rent growth in 2013. Certain aspects of retail have already shown rental growth in the past year. For example, well-located malls, but the overall retail sector won't show growth until 2013.
Well, which sector do you believe is moving ahead faster? If you had to put them in order, which sectors do you think are strongest?
Well, apartments clearly were the leading sector coming out of the recession. They weren't impacted quite as bad. The huge impact on the residential real estate market made the apartment sector more popular, increased demand for units, and so consequently we saw strong rental growth in apartments over the past several years and relatively low vacancies. Looking forward to 2013, we see apartments actually begin to stabilize. They'll continue to have growth in rents, but not at the level we've seen over the past couple of years. And the primary reason for that is we're seeing development activity in apartments. Mm-hmm. In the other sectors, we've seen very, very little development activity. If I were to rank the other ones, I would put lodging next. Lodging has come back relatively strongly over the past year or so. Then office, then industrial, and then retail.
Okay. So retail is the lagger.
Yeah, retail's been the laggard. And what's interesting is we have seen improving consumer confidence, improving consumer sentiment, which should be good for retail. But to some extent, that's been offset by an increase in online sales, which is obviously having an impact on retail real estate. As more sales move to online and less traffic in the stores, that has retailers rethinking expansion plans, often looking at smaller store concepts, and that's negative for the retail real estate industry.
Yeah, that's true, and it may help industrial some a little bit. They've got to ship these toys from somewhere, right?
Yeah, that's a great point, Michael. And what we've seen is some of the improvement in industrial has been as a result of building the appropriate warehouses for the logistics systems of online retailing.
What do you see for commercial real estate lending moving forward?
Well, it's in the downturn, the spigot was effectively turned off around on real estate lending. We have seen some recovery in that, although I would say that there's a huge bifurcation in the market, just as you alluded to in your opening. Well-leased, well-located properties have great access to debt capital. Properties that have some issues, properties that need to be turned around, development lending is still very, very slow. And so there are some challenges still for the weaker part of the market in terms of obtaining debt financing. And then when you take a look at the amount of debt coming due over the next 4 or 5 years, in our study we show $1.7 trillion of debt coming due between 2012 and 2017, $1.7 trillion of commercial real estate debt. Refinancing that debt is going to be a challenge. We're looking at, banks are back in the market. Insurance companies are providing financing to the best of the best properties. But the CMBS market, which was so strong at the latter part, in the 2005, 2006, 2007 era, is still relatively weak and is going to need to come back and be stronger than it is today if we're going to successfully deal with this wall of debt coming due over the next 4 or 5 years.
Yeah, that'd be helpful. Well, this $1.7 trillion that's maturing between 2012 and 2017, how much of that debt do you estimate will require some equity to be refinanced?
Well, TREP LLC estimates that nearly 29% of that debt is underwater. So nearly a third of the debt is at a face amount greater than the value of the property. In addition to that, there's a significant amount of debt that is at loan-to-value rates higher than debt is being underwritten today. So, for example, greater than 75% loan-to-value. So there is going to be a significant need to raise either additional equity or mezzanine capital of some sort to help deal with this debt coming due.
Yeah. Well, I think it'd also be interesting to see, some of these interest rates now are going to be lower than they are on these notes that are coming due. So maybe that'll help a little bit. But, let's talk about REITs. What do you expect for REITs in 2013?
REITs have done very, very well since the beginning of 2009, since the depths of the downturn. The returns have been strong. They've been able to go out and raise capital, not only in the darkest days of the downturn to stabilize their balance sheets, but over the past couple of years to build up, in effect, war chests for doing acquisitions, for deleveraging. For the most part, that deleveraging is done, and REITs are looking at acquisitions. They've been among the most acquisitive buyers in the market, and we expect to see an increase in M&A activity over the next couple of years. Okay,
so you're bullish on investing in REITs?
Well, they certainly have performed well if you take a look at their performance over the last several years.
Right. Okay. What about transaction activity? What do you expect for 2013?
Well, transaction activity came back strongly over the past couple of years. This year, transaction activity, the rate of growth has actually slowed. So going from increases in transaction activity of almost 24% between August 2009 and August 2010, and then 18% from August 10 to August 2011. In the last year, we've seen an increase in transaction activity of only 5.2%. We expect that, and that gets to a level of transaction activity, somewhere in the neighborhood of $200 billion. And, we think that's probably the new normal for transaction activity here in the U.S. So we would expect relatively stable amount of transaction activity in 2013.
Okay. And so why do you think it slowed down a little bit? We're close to the break here, but why aren't we at those levels we saw a year or so ago?
Well, we've actually seen a decline in distressed transactions, and so that's part of it. Second of all, we've seen REITs pull back a little bit in terms of their activity and what they're doing. Third, the transactions have come to market have been pretty competitive, and some buyers are starting to step back now as they look at cap rates, particularly for well-leased, well-located, gateway city-type properties. It's become so competitive that some buyers are starting to step back a little bit.
Okay, well, 4 or 5 cap rate, isn't that a great buy? if you can get capital at 1 or 2%, right? All right, we're going to take a quick break. We'll have more top issues for 2013 from Bob O'Brien with Deloitte. I'm Michael Bull, and this is America's Commercial Real Estate Show. We'll be right back. America's Commercial Real Estate Show is brought to you by Bull Realty. When your business requires proven performance, visit bullrealty.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit agg.com. And Cone Resnick, providing forward-thinking advice to help navigate business and financial issues. Visit coneresnick.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. If you'd like to know the absolute latest on any commercial real estate related subjects, check out our on-demand show podcast. Shows are available on subjects like a show we did on syndications and group investing, covering some big changes from the Jobs Act, which should allow sponsors to advertise for investors. Another example is a recent show on the upcoming tax changes heading our way in 2013, including the 3.8% Obamacare investment tax. There are lots of interesting shows to choose from. You can access the shows anytime on your smartphone or computer, on iTunes, or at the show website, commercialrealestateshow.com. Well, today we're discussing top issues for the commercial real estate industry in 2013. My guest is Bob O'Brien, partner and vice chairman, U.S. Real Estate Services leader, Deloitte & Touche. And Bob, I'd like to talk about single-family homes, new construction. Are we getting a rebound there? How's that going to affect the market?
Well, we're finally beginning to see some improvement in single-family home prices, in sales volume, in new home starts. So after bouncing on a bottom from early 2009 into 2012, in recent months we have finally begun to see some broad improvement across a wide spectrum of markets. Home prices are starting to show indications of improvement. It's slow, but at least we've had several months of trending upward prices. We've seen an increase in volume in terms of existing sales, not a large increase, but at least some increase in volume. We've clearly seen improvement in volume in new home development. Still well below the 1 million homes a year that a lot of people would say would indicate a complete market recovery. But, approaching now 600,000 homes per year, which is a nice increase from where it was a couple of years ago.
Right. Well, that could have a great effect on the economy and commercial real estate if the single-family market improves. Just the real estate agents alone making more money is helpful. But, a lot of the industrial spaces had a vacancy and things and got the cost from the downturn. Well, let's talk about globalization of commercial real estate. Are foreign investors more active in the U.S., and do you expect more of that in 2013?
Well, foreign investors have looked at the U.S. as just in essence, their number one market for investing in. They do like the mix of the stability of our economy, the relative lack of risk compared to real estate investments in other parts of the world, and with the relative low prices, they have seen great risk-reward opportunities. They have been very active buyers in a number of our major markets, gateway markets, focused on well-leased, well-located, Class A trophy-style properties. In some cases, such aggressive bidders that they've taken some of the domestic players out of the game.
Right. Well, I guess that could help our market a little bit. Well, talk to us about sustainability. Is that a big issue in 2013?
Well, it's growing in importance for the real estate industry. Many tenants, many users of space now expect and make it a key criteria for their decision or their selection of a building, that the building employs sustainable practices, that it's green, that it manages energy tightly. They do it in part because of the role they believe they have as citizens of society. They do it in part to control costs and align with their own sustainability policies. But as a result, we are seeing a significant increase in the number of, for example, LEED certified buildings either being developed or LEED certifications being obtained on a renovation of a building.
Well, it certainly makes sense. I mean, as a tenant, you're going to be paying for those operating expenses, right?
Absolutely. And, for the real estate owner, it's interesting. We refer to a study in our analysis here where it shows that a lot of the operating metrics of REITs, for example, that have a high proportion of green properties to the total portfolio, it enhances the REIT's return on assets, the return on equity, the ratio of funds from operations to revenue. And then in addition, those REIT stocks tend to trade with lower volatility, in effect implying lower risk. And so there's some studies that show that there are real returns to a REIT for having a good green strategy.
Yeah, so much for being a good citizen. It's all about the money.
It's nice when they align.
That's right. Well, what about technology? I mean, technology is a big part of commercial real estate today, isn't it?
It is, although, compared to many industries, real estate has lagged other industries in terms of adopting technology. And we see some real opportunities to do that today. For example, technology out there today allows real estate owners to better understand how their tenants are using their space. Whether that's the ultimate consumer, for example, for a mall owner and how they shop in a mall and the traffic that's generated by the stores in a mall, to how a company uses its office space and the employees use their office space. Understanding that can have a real impact on a real estate company as they try to optimize their pricing, for example, the rents they charge for that space.
Yeah, talk to us about revenue management systems. That's being used now in apartments a lot, isn't it?
It is, and hotels have used it for years, and now people are seeing opportunities to use it in, for example, retail centers and office buildings. The way office workers use space has changed significantly over the last 10 years due to technology, and having a good understanding of that today, I think, really helps landlords anticipate what tenants are going to be looking for, either when they renew their lease or as they look for new space. Yeah,
and that's really affecting the size of the office space that these companies are using these days, doesn't it?
Absolutely. Due to employee mobility, the ability to connect from outside the office, you increasingly see concepts of, for example, hoteling and open space and drop-in space type work environments as people move in and out of the office because of their great connectivity.
Okay. Well, talk to us about analytics. How can that be used to power your commercial real estate performance and your decisions?
Well, when we talk about analytics, we recognize at first that companies capture a significant amount of data about the market, about their properties, about their energy use, about tenant sales, whatever it might be. And there are a couple steps to effectively using that data. First of all, you've got to manage it well, right? You got to know where it's at and have ability to access it. And once you're able to do that, there are tools out there today that allow you to, first of all, better understand how the business is performing, allows you then to take steps to improve how the business is performing, and then ultimately, the analytic tools that exist today make you significantly better at predicting how the business is going to perform. So, for example, if you're a real estate owner and you're looking at a major capital outlay, the powerful analytics that exist today can help you predict how well that capital outlay is going to perform.
Yeah, and that's
whether it's an expansion of a property or bringing in a new tenant that has significant tenant improvement requirements.
That's right. You got to know what the return on investment is to make the decision.
Exactly.
Well, Bob, thanks for joining us today. We appreciate your time.
Michael, always fun to talk to you.
Thank you. For more information from Bob and Deloitte's U.S. Real Estate Services, visit Deloitte.com. Stay with us. We have more intel headed your way. This is America's Commercial Real Estate Show. We'll be right back.